Hook. What if I told you the first 90 minutes of every Monday trading session carries a signal most investors completely ignore?
Historically, Monday morning market behavior has shown a measurable correlation with where major indices close by Friday. Most people spend Monday morning scrolling headlines in a panic. The smart money is reading something entirely different. Today, we break down the Monday effect with real data, real context, and a simple system you can actually use. Section 2 Main Content. Let's start with the data. The Monday effect has been studied in academic finance going back decades. The original research found that Monday returns were statistically different from other days of the week. In the modern ETF era, the pattern has evolved, but the signal remains meaningful. Here is what the data shows across a 5-year window for SPY. When SPY opens Monday above its previous Friday close, the index finished the full week higher approximately 68% of the time.
68%. That is not a guarantee, nothing in markets is. But historically, that is a statistically meaningful edge in terms of directional bias. Now let's look at QQQ, the tech-heavy Nasdaq 100 tracker. QQQ is shown an even more pronounced version of this pattern. Based on historical data, weeks following a positive Monday open for QQQ have averaged a weekly gain of roughly 1.3%. Weeks following a negative Monday open averaged a weekly loss of approximately 0.9%. That is a roughly 2.2 percentage point swing in average weekly outcome based solely on Monday morning direction. Now, why does this happen? There are several well-documented reasons. First, weekends create information gaps. Earnings releases, geopolitical news, and economic data all pile up between Friday close and Monday open. The Monday gap up or down reflects that weekend information being priced in all at once. Second, institutional investors use Monday mornings to rebalance positions. Large funds do not trade emotionally, they follow systematic rebalancing schedules. When institutions buy on Monday open, that buying pressure often sustains through the week. When they sell, the opposite can follow. Third, and this is critical, retail investor sentiment tends to follow that Monday open direction. If the market gaps up Monday, retail investors feel confident and add money. If it gaps down, many panic and pull back. That collective behavior reinforces the initial direction, at least in the short term. Now let's tie this to where we are in April 2026 specifically. Recent weeks have featured elevated implied volatility, meaning options markets are pricing in larger expected moves. That means Monday morning gaps, in either direction, could be larger than the historical averages suggest. Key data points to watch this specific week include any Federal Reserve commentary, inflation print revisions, and any major earnings reports from Nasdaq 100 components. Each of these has the potential to drive a significant Monday gap. Being aware of these catalysts before the open is step 1 of reading the Monday signal correctly. And here is what this means for long-term investors, especially retirement savers. You are not trying to trade the Monday effect. You are trying to use it to calibrate your emotional state for the week. If Monday opens sharply lower, and you know that historically this has preceded a down week about 52% of the time, not 100%, you can contextualize the fear. You do not need to touch your retirement account. You just need to understand what the signal does and does not mean. Section 4, 3 Action Steps. Here are your 3 concrete action steps for this week. Action Step 1: Build your Monday market preview checklist. Before markets open, note the previous Friday close for SPY and QQQ. Check pre-market futures. Note any scheduled economic data releases or Fed speeches for the week. This gives you context before the open, so you are not reacting, you are observing. Action Step 2: Set your weekly watch list with intention. Identify 2 or 3 positions or ETFs you want to monitor this week, not trade, monitor. Write down at what price levels you would consider adding to long-term positions on weakness. This turns market volatility from a threat into a potential opportunity within your existing strategy. Action Step 3: Protect your retirement contributions from emotional decisions. If you have automatic contributions set up in your 401k or IRA, do not touch them this week. Dollar cost averaging works precisely because it removes Monday morning emotion from the equation. Based on decades of historical data, Investors who paused contributions during volatile weeks systematically underperformed those who stayed consistent. Keep the automation running. Let the system do its job. Disclaimer plus CTA. Before we close, a mandatory and important note. Everything discussed in this video is for educational purposes only. This is not financial advice. All data referenced is historical and does not guarantee future results. Always consult a qualified financial professional before making any investment decisions. Now, here is your call to action. If this video gave you a new way to think about Monday mornings and market signals, hit that like button right now. It takes 2 seconds and it helps this channel reach more people who need this information. Subscribe to Wealth Decoded if you are not already. We publish daily breakdowns just like this one. And drop a comment below. I want to know, do you check the markets on Monday mornings, and how does it affect your investing mindset? Let's talk about it down there. I will see you tomorrow. Stay calm, stay data-driven, and keep building. End card, subscribe button animation, thumbnail previews of previous videos, Wealth Decoded logo on dark background.